as you see these Morgan Stanley earnings, put them in a broader context. As Jonathan said, this is the last of the 5 majors reporting. What do you make of Morgan Stanley and the financials overall?
Well, I think one thing that we're seeing is, as we said, it's about product mix. So that's one of the reasons I think the big banks are doing very well in this quarter in the FIC. They're managing to harness their lending relationships and get that new issue business. So there's been a lot of investment grade new issue. This was really an investment grade quarter. So you're seeing that, right? The big banks doing very well. And I think Morgan Stanley probably has a slightly better mix of investment grade versus high yield, whereas some other firms that are more high yield dependent have lagged. And now what the real test is going to be is the slowdown in vol, the decrease in vol and fixed income really started kind of in June. So 2 of the 3 months in that quarter were probably okay. It's going to be hard to see how people make it through the next 2 months or 3 months.
Well, Jamie Dimon says forget about the end of June, and maybe that was the indicator for what was coming this quarter as well. It's going to be quiet, maybe, Peter.
It's certainly starting out quiet, right? We saw Treasury VIX, which is the Treasury equivalent of the S&P VIX. That had a multi-year low of 3.75 just last Friday. So you're seeing the same thing happen where volatility shrinking, turnovers reducing. Hopefully we get something that changes it around, but right now I think it's been a slow start for FIC.
And you pointed this out, Peter, that if you look at the risk parity index, the salient risk parity index, which is those that bet on stocks and bonds at the same time, we've actually seen realized volatility pick up. Nowhere near where we were, obviously, in 2016 around the election, but nonetheless, that pickup, A, is that sustained, and B, is that reflected in other parts of the market?
It hasn't been sustained yet. It keeps drifting back and forth a little bit, but I think that is a crucial element. When we get those spikes in risk parity index vol, it means you've got commodities moving, rates moving, equities moving, which I think is great for the big money center banks.
Right, so then that should be good for the likes of Goldman, because my big question yesterday was, are they going to have to dump out of their commodities business in some capacity?
Yeah, that I don't know, but I do think we're going to start seeing a little bit more of this cross-asset correlation pick up again. Everything's been so muted in terms of volatility and lack of correlation. I think the big banks really need that to fire on all cylinders.